What up, what up, what up? We're back. Another episode of Get a Load of This Trucking Podcast. Welcome. I appreciate everyone hopping in today. As always, your host, Cameron Pechia, and owner and founder of Valley Trucking Insurance and one of the co-founders of the podcast. And with me, I've got the other co-founder, special host, I should say, Ryan Young. Ryan, what's happening?
What's going on, everybody?
What up? What's new in the trucking world? What are you hearing from the fleets and your clients and stuff in regards to fuel or cargo or loads or anything?
I mean, it's a mixed bag. There's obviously a lot of noise about gas prices, which is understandable. They're a little nuts at the moment, more than we've ever seen. Look like they're going down a bit, but I do hear some people talking about the contracts they have, and they're just getting better and getting fuel surcharges. So I think in that mode, the industry is good. You know, seeing a few cancellations with people, deciding to take a break or go under some other bigger operations, which isn't necessarily a bad thing because those guys have the contracts and can make the pay. So I don't know, I'm hearing a lot of good things, man. I mean, the industry's changing a little bit, but it's dynamic. So, yeah, things are good.
People are bitching about insurance costs going up.
Oh, I mean, that's even if it went down, they'd probably still bitch. So,
insurance,
you can't stop that.
Insurance is the exciting part. And, honestly, we haven't done a ton on the insurance piece and shared our expertise there, but there's a lot of exciting opportunities, and you actually have a lot more control over your insurance and what it costs than I think people realize. And that's actually who I've got on today. I am stoked. I'm super excited about this one. I think there's going to be so much awesome content. I want to dive right into this. And with us, we've got a special guest, Ian Mayster. Ian comes to us from Captive Resources, and captive might be a new term to some. I've had a few guests or listeners, I should say, request it. Some of the larger fleet companies that have heard their buddies that are in captives or have heard about this insurance that they actually get to control and have a say in and make money on. And there's a lot of exciting features and components to it, but it's a lot more complex than a traditional insurance. And it's exciting. So Ian is coming to us from Captive Resources. Ian, what's happening, brother?
Hey, Cam, Ryan, thanks for having me on today. Looking forward to chatting with you guys a little bit more about group captives.
Yeah, man. Tell us a little bit about your background, whether it be academic or professional, or what led you to the point to where you're now dealing with wheels, trucking, and the insurance piece of that, and finding awesome solutions for your large fleets.
Yeah, no, definitely. I appreciate it. I actually, believe it or not, studied insurance in college. Did not think I would go down that route, but it worked out pretty well. I tied it with a finance major, and shortly thereafter is when I got a call from Captive Resources about an internship program, and jumped on that and did a summer with them. And by the end of that year, I was like hooked. It's just a very, very great organization. The captive concept itself it was so unique to me at the time, and just seemed like the best way to do insurance. And so I did everything I could in my power to make sure I landed back there, full time. And I've been with the company now over 5 years, and it's been a fun ride. A lot of good growth over the years, and certainly plenty more to come here in the years to come.
And you're on the business development side, so you get to do a little bit of boots on the ground, some education to the fleet prospects or existing customers, and travel with them. Is that what makes the job awesome? Is you just get to deal with trucking clients and just awesome people, or what?
Yeah, no, I think that's probably one of the best parts about the job, and you guys, pretty similar in that regard, where a lot of people think insurance is pretty bland and the day-to-day of it, but really in our world, we get to sit down with business owners, CFOs, and trucking specific companies, and really peel back the layers on their company. I ask some questions that not a lot of other people get to ask, and learn more about what they're doing, how they're operating, where their areas of concern are, and how we could help possibly find them a very good long-term insurance solution with the group captive. And so, usually it's every day is a little bit different. You're working with new companies. Everybody's got their own little caveat differences in their programs and how they're running their trucks.
That's awesome. I think one of the exciting things, and this is usually what the topic, or maybe how it gets brought up to me is, hey, my buddy who has a fleet of trucks is with this captive. They're not, either they've heard about it or they haven't. Maybe they're new to exploring the idea. And it's like he gets money back on his insurance. He gets a say in what they do and what they don't get to do, and what attorneys can help represent them in a claim. Can we fight this claim? And I think that that's the appealing stuff. And today, what I hope to accomplish with you, Ian, is talk about the high level things, some of the benefits, some of the exciting things, but also talk about, at what stage does your company as a fleet owner and as a business owner need to be at to start discussing, should I be in a captive, or maybe think ahead, future forward thinking, which we got a lot of clients that do that. Hey, here's at what point you should actually entertain this. And this is what point that we'll start talking to Ian or talking, you know what I mean? And see if we can't get you in. Right.
Yeah, no, definitely. And I think the educational piece is arguably the most important to all this, because it can be a great, insurance product for a number of companies, but it's important to understand, the ramifications of it, how they work, the cost to get into it, and then, what the timeline is for your business and expecting, these dividend checks to get back. I think I'll step back a little bit and explain, captive resources a little bit more holistically, if I will. Really, we're a group captive consultant. And so kind of how that works is we work with brokers around the country. We don't have, we're not owned by an insurance company or any agency or anything like that. And we form member-owned group captives. And so we're the primary consultant, really just working on, bringing all these parties together, whether it's the insurance broker, the company, the reinsurer, the third-party administrator. Really, our job is to just bring everybody together and create this unique product for some of these best-in-class companies. So we started in the late 1970s, early 80s, and it was a harder workers' compensation market at the time, and went out to some Chicago businesses. That's actually where we're headquartered, in the Chicagoland area, and said, hey, you guys you're all doing the right things. Together, maybe the 5 or 7 of you make up about $1 million or $2 million in premium. Rather than paying that to an insurance company every year, what if you took on some of that, that risk yourselves, and then reinsured away any, big catastrophic loss that you weren't expecting? So it allows the business owner to really kind of, get more involved in their insurance program and see, okay, well, if I'm paying $500,000 a year and, $600,000 or $400,000, $300,000 might be seeded to, pay for claims, maybe I'll take that on a little bit more differently myself and really implement some more risk management approaches in hopes to get that dividend back. And so that's really kind of how our model started. It worked out really well. The clients, they bought into their insurance program. They worked with their insurance broker a lot more and developing loss control techniques for their fleets or, their employees' safety. And ultimately, it led us to create more and more programs for a variety of different industries. And now today, we've got over 40 different captives and a number of them serving the transportation industry exclusively. So a real unique opportunity there for some of those larger fleets that, maybe are frustrated with paying, significant auto liability premiums and just seeing it go up year over year without really much benefit on the back end. And so that's a good time that we come in and say, maybe it's time for you to, take a look at a group captive and see if this is something that works well for your business and your organization.
Yeah. And a lot of those folks, I think, tote that they're best in class. And it's like, hey, I'm paying insurance premiums that are the same or similar to XYZ company. However, they can see like the out of service alerts or crashes or anything because it's public data via Safer. And it's like, why am I paying the same that they are? I feel like I'm operating, more safely. I've got a culture of safety. Like we invest in training, we invest in tech, but my insurance, premiums don't reflect that. So I think that's what leads a lot of the conversation or folks to discuss this or explore that. And the other thing there you talked about is, having control over what claims get settled and don't get settled, I think is a huge thing. Cause that's a common complaint I get as well, is like, hey, the company just settled this claim, right? Now, sometimes the insurance company knows best and they know the venue and they understand the implied cost of fighting this and what's going to happen. But sometimes it's like, gosh, we shouldn't just settle this claim. We should actually fight it. And when you're in a captive, Ian, correct me if I'm wrong. It's a little bit different claims handling process from the sense of it's their dollars at work. The attorneys and the claims managers and everyone know that it's their dollars at work, so they're a little bit I don't want to say more sensitive to that fact. I guess they are, but it could be handled differently. Correct?
Yeah, no, and you're certainly right on that, Cam. And really, we see a lot of companies that join a group captive program just for that reason alone, right? They've had instances in the past where claims happen and they clearly know and can possibly even prove it that, they're not at fault. But the way that the insurance market works is the carrier steps in, they realize, okay, what's the, most cost-effective approach to this? To us, it's just easiest to settle for $10,000 and then move on. But then in the business owner's eyes, they're saying, well, wait a minute, I know that didn't happen. Like that person, we've got video footage of them driving into one of our trucks, at this intersection, blowing past the stop sign or something like that. And so, a lot of times the captive provides that option and opportunity for them to go ahead and fight claims, right? They don't have to continue to, follow the insurance company's recommendations. Obviously, you got to, honor everything that's going on in, in the eyes of the law. But if they work with their TPA is going to understand that these are, their dollars that they input into the premium and pay for these claims. And if they want to spend a little bit more on a particular claim to fight it with the hope that, this might not happen to them ever again because, people know that it's not a company you want to mess with, then that's more power to them. It's something that they could, receive through being in a group captive program.
I think it's cool, too, because you mentioned the word group, right? And captive, I think, is misleading, but group, you're amongst your peers. You're amongst other companies that are best in class because it is reviewed thoroughly whether or not that captive or that group captive is going to take you on as a new client, because they're going to review. What are some things that you're going to be reviewed on, Ian, when entertaining this? Like just for somewhat transparency for a company that's thinking about it, so what they have to prep for.
Yeah. So, first off, we got to make sure that they're of decent size, right? So we really look at, fleets that have probably at least 20 to 25, tractors, power units. And then from there, we should have a good amount of dollars to work with because really, in our industry, you could have one bad accident that can cause, upwards maybe of $1 million in claims. And so we want to make sure that there's, adequate funding for the reinsurance company, but also for the insured, right? Because they're paying for their own claims as they happen. And so if they have a bad year, they could have to pay more. And so for those reasons, we want to make sure that there's enough premium there. So, we typically say a small to middle market trucking operation starts to fit in that box. But then beyond that, we really look at the losses and we look at the workers' compensation, the general liability, and the auto liability, and the physical damage in particular. And what we find that those are the 3 or 4 lines that are really most predictable, right? And so if we can look at 5 years of their history and how their trucks are running or how their employees are, staying safe, if they've got a good track record, we can probably assume that in the future, they're going to continue to have a good track record of safety and claims management. Whereas other, areas of within insurance, property, things like that, you can't guess when there's going to be a tornado or a hurricane, things like that. And so, we look at those 3 lines in particular, and if they're performing well, given the premium, then it's time to look at a group captive. And we could say, hey, you might have paid out $4 million in premium over the last 10 years, but you've only paid out maybe $500,000 in claims. So all that money that's still sitting on the table, that should really be profit for you, we think. But instead, that goes right to the insurance company's bottom line. And then next year they come back and they say, hey, you know what? Only a 1% increase, you're doing good type of thing. So that's kind of a couple of things that I notice. And then beyond that, it really comes down to the safety and culture within the group. We want to take good companies and make them even better. We've got a ton of loss control services. And, as you're mentioning, Cam, the group aspect of it, we do group safety workshops where all the safety directors come together, typically for a day or two and really just have a best practices session. So we're looking for companies that can really buy into that philosophy, get into the group with other like-minded business owners that are just constantly looking to incrementally increase, that their safety risk management program around the company.
Yeah, and I think this is a really excellent idea. And as far as being a group and the captive, it kind of, at least in my mind, it makes sense to call it more of like a cooperative almost, to say, hey, you're joining forces with these companies and you'll kind of have a seat at the board to make decisions. Mm-hmm. But I think that a big question listeners might have is, how do you select what companies are going inside which groups? And, are there potentially, like, I guess, benefits or consequences if they're not in the right groups? Like, are they categorized a certain way?
Yeah, that's a good question. Typically we try, we've learned over the years, what works well together. We realize that, maybe long haul truckers with, restaurants aren't always the best group setting together. Right. Sometimes that happens, but, for certain industries like construction and transportation, to name a few, and some of the other higher hazard groups, it makes a little bit more sense to put them together, right? And then we can tailor the risk control profile for that specific industry. And like I was talking about safety, everybody's got, a fleet. Everybody has run into a similar issue. And so for those reasons, having the group specific to transportation, shall we say, it could be very advantageous, right? More often than not, if you're a safety manager and you're saying, hey, we're really having a hard time with hiring lately, right? We can't find good drivers. Somebody else in the room might say, hey, we just came across this real unique resource lately and it's helped us, find drivers. They might be on the other side of the country, but since you're in the captive together, and like you said, Ryan, that cooperative nature of it, you're all trying to, get safer together because it helps everyone in the group's bottom line. I think it's important to mention, these are member-owned captives, not anybody, nobody from the service provider standpoint or captive resources. We don't own or vote on any of the captives that we consult to. It really is completely up to the owner of the company that's a member in these group captives to go ahead and make those decisions and earn those profits back. But in terms of the upfront getting into the program, like I said, the educational piece is pretty important, right? Understanding how it works. Is this something that you'd like to look at further? There is some risk that's involved, right? You could have to pay a little bit more if you run through your claims funding, your loss fund in too short of a time. Right. But at the flip side, right, it's kind of finding these entrepreneurial business owners that like betting on themselves and want to take on some of that risk in hopes that it'll drive down their costs and, more importantly, send everybody home at night at the end of the day. Right.
And we've discussed this a little previously too, and I was wondering if you could go into a little bit, maybe incentivizing like how the profit sharing works, like how or profit sharing, I say, but what are the returns like, to kind of get people interested in what this actual idea is bringing a benefit besides the obvious safety advantages of just having incentivized,
right?
Reasons to put safety in place.
Yeah, great question. So we did a study, and I could probably find some more information on it here, but looking at about 15 programs that we consult to, I think the average dividend return was somewhere around 23% of their premium, and so almost a quarter, of their entire premium that they could get back over time. So for some of these bigger fleets that are running $500,000 or more in premium, that could start to really become a sizable amount for them to get back. In terms of how the dividend actually works, it's going to be very much based on the actual business, the owner themselves, and how their fleet's performing. There is risk sharing involved in the group captive here, but it's nice because that makes it true insurance, right? Otherwise, this would be self-insurance, and you start to get into a whole different type of tax program and structure. But the bottom line here is that the majority of the dollars that you could potentially get back through having a good year, they're in your control. Only a smaller portion of your total premium is what we would call in the sharing layer with the other members of the group. But that's important too to have because, if the three of us were in a captive and I only had, $200,000 in funds available and I caused a $500,000 loss, there's going to be some extra room I need help with from you guys to get there. And everybody, learns from the captive. They understand that it's a little bit of a give and take. And ultimately, majority of the money you could get back, like I said, it comes down to how you perform rather than everybody else in the group. But like what we were, saying earlier, they're tough to get into. You got to have all those controls in place. You got to be around, and at least five years or more, and committed to safety. And so that's why when we get all these members together in these group captive programs, and they're all like-minded, they think the same. That they're very cautious and they're taking all the right steps in place because they don't want to be that guy in the room that's had big claims for the last 3 years, right? Somebody's going to say, who's this fleet over here that, we don't know who they are, but it looks like somebody's having a lot of accidents year over year. And that's their worst nightmare as a captive member, right? Opening up a can of worms there for people to poke questions on about their
and
program.
It's not something to take lightly when evaluating that. Something else that's cool about the captive programs for the truckers is you guys go up to $2 million on the primary auto liability, which I think is huge to note. And it allows us to purchase an umbrella or excess liability at a little bit cheaper rate because we're a little bit higher on that underlying. And then you'll also cover the physical damage and the other components as well. And we can build in contract specific coverages. I don't want to get too much into that, but just to express the diversity and like we understand trucking, the captive understands trucking and what they face and the contract language and what it looks like. We have a solution to cover that essentially.
Yeah. And then to your point, Cam, it's in this day and age, the umbrella market, it's sometimes hard to explain to clients and prospects what's going on and how it, is affecting their entire insurance program. But in our eyes, it's tough, right? And it could be a very expensive piece. We see these nuclear verdicts come up around the country, hundreds of millions of dollars in claims paid out. And so, having that at $2 million attachment point makes it a little bit easier. And for you placing that umbrella and overall for the clients, total cost of insurance, we find that helps alleviate some of those stress.
I think so. And to probably simplify a little bit of the entry points, and you had highlighted, 5 years in business, that now gives the ability to have some financial strength, and people that are operating at that size typically have been in business a little bit longer or in some capacity been managing or operating a fleet anyway. The other is have financial strength, have the ability and have the ability to diversify with your funds and place funds elsewhere. However, what I thought was really cool about that is there is some buy-in cost associated. There is some guarantees that you got to put in place and you got to basically put collateral up. But what's really cool is you make interest on that. So let's chat about that, Ian, because that tends to be one of the more highlighted features of a captive from what my conversations have been is like, yes, you get money back. Yes, I should be getting, my performance of 5 to 10 to 20% back, but also your ability to earn money and earn a little bit of interest on that money that you have parked.
Yeah, definitely, Cam. And that's, I think a very unique portion of the group captives that we consult to. In the early 90s, we realized that, to be a big name insurance company and compete with, some of these big companies like, Zurich or AIG, whoever it might be, all of these companies, when an insured binds coverage with them, a lot of those dollars get invested in the market, right? So the carriers, they've got their combined ratios and they're making money on the underwriting, but not oftentimes does that make them profitable. A lot of times they get profitable from the investment income that's accruing. And so, we were talking about those 3 lines of coverage, the work comp and the auto and general liability, that they're the most actuarially predictable. They're also some of the longest tail lines in insurance, which means it takes a while for these auto liability claims to get paid out, for the workers' comp claims, to, injuries to materialize and be complete and have our, claims closed. And so, what we decided was create a mutual fund for all of the clients in the captive and allow them to invest, their loss funding portion of the premium. So not the fixed cost, but essentially the amount of money they set off to the side to pay for claims. And so, when those large, work comp claims or the auto liability claims, they might take a year or two to settle. During that whole time, the client is actually earning interest on their premium, from the beginning. And so it really allows us to kind of come in there and say, hey, join a group captive and you become the owner of an insurance company. And you get all those benefits just like the big name insurance companies do. And so, the fund really allows for that participation. And oftentimes what we see is sometimes companies might have, 30,000 in claims over those 3 to 5 years as we're waiting to see everything materialize. But the fund might produce 40,000 in interest on top of that. So really it's almost like a wash in terms of your claims. And so when you start to kind of step back and think of it in more of that, wide angle view of the overall program, it really does start to make a lot of sense from a long-term objective when you're looking at a business that is not looking to sell anytime soon, and possibly create another financial vehicle, a little source of revenue for the business.
And I think it's important to note too that while they are taking on more risk, they are operating a little bit more as the insurance company. They're not taking on the whole risk, right? There are stop losses and caps to this thing where reinsurance layers come in and then the actual insurance comes in. And then when you're doing the actuary side, meaning that, hey, when we evaluate your losses over the last 3 years, you're not going to get penalized if you had $1 million loss. You're only going to get penalized to a certain extent for the future rates that you're going to pay. Let's not go too much in the weeds on that, Ian, but let's talk about just kind of on a surface level what that means to the client, just in terms of education.
Yeah. If we don't have to go dive into an actuarial analysis or anything.
The listeners have dropped off at 25 minutes if that happens.
We don't want anybody falling asleep while they're driving.
It's super cool though, and it's actually very important to the fleet or the business owner and the fleet managers or CFOs or whoever is like in charge of this project and making decisions on this, because what that means is like they're limiting their risk, they're limiting their exposure. Because they're reducing their risk, they're taking the necessary steps. They're not going to get penalized. And then also the other thing, which I think is a huge benefit to the captive, is it's a predictable model as to what your premium is going to do. Whereas in the traditional market, you hope your premium goes down. You can do everything right, but if the market suffers, your rates could go up, and you could be blindsided. A company could pull out of the market. It could be. I mean, who knows? There's a ton of things that happen in these horror stories you hear, whereas the captive, in my opinion, at least since the 80s, since you guys have been around, have been a little bit more predictable to an extent, and at least they feel like they have control, right? So.
That's pretty accurate, Cam. And I mean, I get calls, all the time from brokers that say, hey, this insurance company, they're pulling out of the market, after 5 years, not really much explanation why, but we need coverage, right, for the next year, or the upcoming renewal, something like that. And it's frustrating, right? Because an insured, that shouldn't be the case. You shouldn't have to deal with, a trusted partner just calling up one day and said, hey, we're not going to offer our coverage, our solutions anymore. And so, back to your point on the captive side, what's really unique is how we price these risks. And like I said, not everybody could qualify. They are oftentimes pretty difficult to get into. But if you want to, like you said, take on that control and really try and drive down those premiums on your own, that's entirely capable with the group captive. And so how we price it, to your point, that the actuarial loss study, we look at 5 years of data, looking at how they performed, how many accidents have they been in, how much did each accident cost, right? How many vehicles do you have? Are you looking to have more in the next year? And then really from there, develop a premium. And so it's a pretty straightforward model. And typically, after spending a couple of years in the captive, we'll have CFOs come up to us and say, hey, I'm expecting it should go up about 7-8% this next year, just because they know they're learning how the model works. And it's fascinating because, you can't get that elsewhere. And so for some of these bigger organizations that, when we're talking fleets, trucking insurance and auto liability, that becomes a pretty large piece of their budget. And so if they could forecast where those costs are going to be, in 2, 3, 4 years from now, given maybe how many trucks they're expecting to have, and then also in turn looking at, their loss costs and the actuarial study, they really know, okay, I expect it to be pretty much right within this range, given all that information. And it's just something that, we can't always, see in the standard market and
right.
count on by some of the carriers. I think it's just under about 11 years in a row now. Each quarter we've seen either flat or consistent increases on the auto liability for just about every.
Yeah, and there's a multitude of factors for that are outside the control of the insurance, right? Labor, material shortage, distracted driving, more people on the road, cost of injuries. You had mentioned nuclear verdict, and so there's different venues in the country that have adopted different theories, and the attorneys have adopted different tactics to basically extract the most money they can out of these insurance companies, and everyone's feeling that impact, right? It's not just the guys that are causing all the issues or causing accidents or anything. You could be a perfect operating company and you're still feeling that. It's still going up. And so At least here, you have
Yeah.
the ability to earn a little bit of profit. You have the ability to get some money back and not leave it on the table or in the insurance company's pockets, which that's awesome. And then Ian showed a slide, which we don't have slides for this. I guess we'll do more of a verbal, but in a nutshell, since this is established and since the fund has been managed, you guys have been profitable for well over the last 30, 40 years, right?
Yeah,
I mean,
talking as
we
a
can
whole
break
or in
down by
terms
5-year,
of,
10-year, and then as a whole. But most impressive is like everyone expects to take a loss in the market for a fund right now, but we're not, and we expect it too. But we're hedging over a 3 and a 5-year period where actually we're making returns on the money. So your money's making interest, which is another dividend check that you get as an owner of this captive.
Right. Yeah, and again, it's just kind of bringing all those dollars back into the control of the insured, betting on themselves. And to your point on that mutual fund, it's actually all run by, typically the CFOs from various, captives that we consult to. So it's almost like, not even ours. It's really the clients, and they're the ones that make decisions and interview, different money managers on it, and so on and so forth. And so it's really unique to see, it continue to grow, and it's created, quite a good lifeline for a lot of these companies. And just to give you an example, some of our captive members, let's say they joined in 2010 or 2015, when the pandemic hit and they were, they didn't have many routes or they didn't have a lot of revenue coming in. Some of them were getting some pretty solid checks back and dividends from their captive program. One, because they were running safe operations, and two, the timeline between 2015 to 2020, the market did pretty well. And so now those are their dollars that are in this fund, along with, their control over, within the captive, getting, whatever claims they don't pay out, they get that back. So it really can increase exponentially over time for some of these business owners and their companies. And, like I said, create a safety net in times. And so it doesn't always make the most sense to jump into a captive. Like I said, the educational piece is really important. You got to understand, some of the costs associated with it and getting in. And oftentimes I say, hey, look, if it's more important for you to buy more trucks or hire more people, that's more important, right? Focus on that, get your business to where you want it to be. But once you're there and you feel pretty comfortable with it, and maybe it's time to look at that captive solution. And I think it could really be create a strategic option for the overall company.
Well, I think it's also cool. A line item on that budget or proposal, if you will, is allocated towards safety or safety resources. So at the end of each annual term, each of the companies gets a percentage of money back to invest in training, technologies, speakers, whatever. So elaborate on that, Ian, and maybe not the fact that you guys do that, but maybe some of the success stories within the captive and some of the feel-good stuff that you get feedback on.
Yeah, no, definitely. And really kind of to your point there, it's a line item on the proposal. It's an incentive, to use a little bit of their premium back towards them in terms of funding new risk control ideas. And it just shows more power, right? If these companies can, take that on and find unique ways to get safer, at the end of the day, it only helps them more and more than anybody else, right? And so a lot of times, we talk about telematics in transportation. I'm sure you guys talk about that plenty enough with clients and other colleagues, but, we see that quite a bit, right? Where companies join the captive, they say, we don't have any cameras yet. Maybe we'll use that. I don't know how our drivers feel about it just yet, but, everybody else seems to think that it works well. And then what happens is, they install the cameras, and then the next accident that happens, the driver is actually the one, the insured driver is the one that's saying, thank God those cameras were there because you guys wouldn't have believed me when I tell you what just happened here. And so we find that more often than not, for some of our fleets, that it's actually more beneficial to have either, both driver-facing cameras and road-facing cameras, because the drivers are very good. They're qualified. They know what they're doing. And most of the time, these captive members, they got very, good hiring practices. And so more often than not, it's like you said, some of these, attorneys or just people out there looking to cash in on some large policy limits with truckers. And, unfortunately just trying to cause accidents, right, and drawing on those large insurance policies. And so, when our captive members and have these checks in place, it often avoids those situations, and everything going on there is just terminated, right, in terms of the claim with the third party. There's no litigating that anymore. It's clear evidence that our insured truck is not at fault here, and that's it. So that's one case. Obviously, there's so many different aspects you could use for those loss funding dollars. And typically, when we have those safety meetings, getting all the safety guys together, they sharing those ideas too. Hey, we brought in the speaker. He told us all these unique things, these different stretches, things to do before starting the day. And so, it works. It's been working for our guys. And so, all these things over the years, bringing them back to the, guys and girls in the shop and talking about it, it really just adds up to create a much more safer environment.
And where are some of the meetings held? You were mentioning a couple of places, or kind of the how these meetings are conducted on the annual basis and the owner meetings and stuff. That sounded awesome.
Yeah, no, definitely. And so that's, one of the most important things that we think about the captive is getting all the directors together, right? Every company that joins, they become, they have a seat at the table. They're a part owner of this group captive. And really our view at Captive Resources is to provide them kind of a consulting overview of what's going on in the insurance market, and really just run the captive for them on the day-to-day side. But then they get to come together and make decisions on service providers and, different structures within the captive. Maybe we want to take on more risks. And so, there's a bunch of different domiciles. We've chosen Grand Cayman as pretty much our go-to. We started there back 30, 40 years ago. And so for that reason, our groups get together outside of the U.S. And it makes it a little bit more unique and enjoyable. Our captive members, they're often a little bit more excited to get together. And I'll tell you, the first one I went to, I felt like I was so out of place. Everybody was like a big, tight-knit family. Going up to Canada in the summer months or the Caribbean in the wintertime. But just a very unique opportunity. Spouses and families get together. There's networking, but then there's also plenty of business, talking about what's going on with the captive, what changes we want to get, put in place, or things we want to consider going forward. And so, typically, they join the captive and they're there for a while just because it really is, insurance program designed for the client in mind. They get to go to the meetings, interact with the insurance company and the underwriter, interact with their broker if their broker comes by, and then all the other members in the group, right? And hear and grow with them. And a lot of times, sometimes we get to a point where the captive has been around so long that the next generation from one business is taking over, and the next generation from another, captive member, and they're all meeting together. And so, it's a really special time. When we do get together.
I think it's worth noting too. You had mentioned the retention component is very high, and usually I think because it's a long-term investment, it's a long-term strategy, it's a well thought out process, it's a sophisticated trucking company, so they know what they're getting into. But what has the retention been? It's mid to high 90s, right?
Yeah, so we've pretty much been right around 98%, for the last, I would say, probably at least 10 years. And really that 2% that, we lose business, we look at, pretty tough figuring out why that's going out. But more often than not, we see just a lot of companies that, are getting towards that point where the owner is getting ready for retirement. You think about the baby boomer population, a lot of older Americans that started successful businesses, and they might not have succession plans in place. They might not have kids that are either interested or want to take over, or just don't have children there at all. And so in this market, in this day and age, private equity, as I'm sure you guys are very familiar with, and other larger investment groups, it's the captive members that we consult to, they're very well-run businesses. They look really good on paper, and typically they're even better people. And so for those reasons, somebody might call them and say, hey, we'll give you $50 million for your business if you want. And it's kind of hard to say no, right? I've never been in that position, but I think I would probably say yes if somebody wanted to give me a check with that many zeros. So more often than not, that's typically where we see our lost business. But yeah, for the most part, they'll renew in the captive. And really, it just comes down to, if you buy into it, you understand that the concept, you like it. If you had a bad year, that's okay. We're not going to punish you. But yeah, I mean, if you hang on in there, it could be a really, really good option pretty much until you're ready to sell the business or get out of it.
Yeah, and I mean, it sounds like that level of retention at 98% is, I mean, it speaks for itself, right? So 98% retention with 2 to 3% being lost mostly because of getting, large checks to get their companies bought out. You're not seeing people leave for, negative reasons necessarily. And I mean, to me, it's just saying, well, this is obviously a great opportunity for somebody who can get into it. And, I imagine the people who listen to this and are actually in a position to are probably going to ask where to sign up or at least where to inquire about it. So I did have a quick question in regards to safety too, just to double back a little bit. Obviously, safety is huge. The programs can incentivize safety for companies. But then we talk about, it's not a very easy program to get into. What is the ideal client? I know we spoke a little bit about it, but what kind of markers are you looking for safety-wise? I mean, we don't have to dive too deep, but so somebody could kind of self-assess themselves listening to this. Great question. And so I think it's all relative on the size of the business, the size of the fleet, for looking at truckers specifically here. But typically we'd like to see maybe one big loss in 5 years. Again, depending on the company, if they're closer to, $1 million in premium, we could see a couple big losses there in terms of, and when I say big losses, we're looking at anything, between 150,000 upwards, 500,000 or more in terms of, one total claim. And so, in this industry and specifically in trucking, that happens, right? It's, it could be one simple little accident that really goes the wrong way. And a lot of these things, the cost associated with it really adds up. But in our eyes, we want to look at how you're managing those claims. So, if you're doing a good job, you don't have a lot of those big catastrophic claims, and then also not too many frequency claims, right? If you've got a handful each year, that's okay. But, a lot that kind of adds up over time, we might be saying, okay, well, what kind of safety program do you have in place? Or all those, benchmarks and metrics there to avoid things like this happening. And then beyond that, financially stable, the actuarial study, we look at 5 years of, company data. So they got to be around for a little bit. And there is a little cost, extra cost to get in and collateral to suffice all the parties. Again, you're taking on some risk and you want to make sure that you're good for it. And, you could pay that all back when the time comes. And so being financially stable, realizing that there's some extra costs associated with getting in. And so I say to companies all the time, hey, I'm glad you're interested in it, but let's talk. Is it a good time now in your business life cycle? Like I said earlier, are you looking to buy more trucks this year or a new property? Think about that. Where's your working capital going to be? And then beyond that, like I said, I think the mindset of the owner and the management team, how important is insurance to them, and the total risk management, overview for their company. If there's buy-in there, they might not, even if they're not, the best performing company, but they said, hey, 2020, man, we had this big accident. It made us really reevaluate how we think about insurance. Right. We've done X, Y, and Z to combat, a lot of these things. I'd say, hey, you know what? I think you're getting ready to become a good captive member. Let's continue the conversation. Okay. And so, for those companies, entrepreneurial, they want to, put their money where their mouth is and invest in safety and really try and lower their total cost of insurance. And over time, then let's have a conversation. Yeah, and I remember you, and thanks for that, by the way. But I do remember you too, correct, if I remember correctly, you saying that it is actually quite a long process as well. So, you're having conversations with people, potentially disqualifying them. You have a pre-qualification, permission, and then what's the process?
So, definitely. So I've had, a lot of times we'll talk to companies just after the renewal and start teeing it up for next year and say, hey, start talking to other people about this. If you know anybody that's been in the captive, or talk to your CPA or attorney, sometimes they know of other, colleagues and industry folk that have been involved in situations and programs like that, talk to them. Or sometimes we'll have conversations about, hey, you're just not, at that level of sophistication yet, or you've got some losses on your 5-year window that, we probably couldn't give you the best option out there. Cam and Ryan could probably find a better option for you right now, but let's talk about getting captive ready. what are some steps that you could take in the next coming years,
Awesome.
and things you could implement around your organization to help become a more suitable captive member for those things. And so it really is a long time. It's pretty rare that I'll get a call and from a broker and they'll say, hey, this guy wants to join a captive next month, we'll get you all the information over. That's tough, right? And I don't like doing that because I really want the insured to understand it completely before they get into this. All the moving parts, the group members, sometimes even check out, board of directors meeting and see who else they'd be doing business with. And so, that process can take time. It's often a lot more work up front. But once they're in the captive, it's a pretty straightforward process. And we've got a lot of, systems in place to make sure that they're happy, satisfied, and serviced.
Well, and I'll make it super easy from our standpoint. Awesome. On our website, valleytruckinginsurance.com/captive. They'll be able to plug in their info, their DOT number, a little bit of information, and we can actually do a little bit of pre-screening prior to them even thinking about it. And Ian and I, and Ryan and Ian and I could get together. We'll do the legwork. And if it comes back, it's like, hey, this company looks really good. They're solid on paper as far as safety goes. Let's take the next step. And I'll have a scheduling link where they can book a meeting and we can literally sit down and chat and explore further if it makes sense. And so literally they'll just have to plug in a little bit of info, their DOT number, and we can do the rest for the initial consult. So.
Yeah, I think that's fantastic, Cam. I really like that idea. And then, if they're interested, we do a little educational meeting. It would be nice to, specifically tailor the conversation to their own company and hear about what they're doing. Yeah. And then, maybe meet in person if they need it. Like I said, I'm down here in Phoenix and it's 107 out. I'd love to be up in Spokane right now. I'm sure it's probably not too much cooler out. But if you got anybody else in the Northwest, I'm happy to come
I think
by
the things to
hello.
point out is the exciting stuff. It's like, hey, you got 50 trucks. You guys are doing well. You're a healthy business. You guys have cash and money in the bank, and we want to make some money. You want to have control over the insurance. You take pride in having a culture of safety, and you want to get rewarded for that. Then it's like, let's talk, And as simple as it is, it's like, go to the website, to the valleytruckinginsurance.com/captive and put your DOT, a little bit of info in. We'll get in touch. We can then schedule a meeting or do an on-site meeting, whatever we need to do. And, you can do this at any point because as you pointed out and as Ryan said, you're not coming the week of renewal and it's like, oh shit, I got to shop insurance and captive's the way to go. Obviously this is a little bit longer term investment. It's a longer term play. I consider it a diversification of their business and their resources. Like it's going to hedge versus those bad times, which you pointed out. Some of those companies that maybe weren't as strong coming through the recession with relationships or the markets or whatever they were hauling for whatever reason, still ended up being profitable because of stuff they had done to that point. Now they're making money on dividends and getting money back off of their premiums and stuff like that. So it truly is an asset. It 100% is an awesome resource. It's a viable component. It's not built for everybody, but that's why we're here to try to help educate that and then have that conversation. And if it's not for you now, well, and if you want to get there, let's start talking about that too, because everything we do on the insurance side at Valley Trucking is geared at getting you to be best in class, is getting you to think about and maybe challenge hiring practices. Do you have proper safety in place? Are you utilizing technologies? Are you utilizing ongoing trainings? We offer driver trainings to our clients, so they're just based on push notifications to the cell phones, and we can see what one of their drivers have completed a training or haven't. And then after they complete certain modules, they get certificates. Like these are all things that we are doing to help give back and help promote and help empower the carriers to now start reducing premiums, start getting buyback from the insurance companies, start getting rewarded and recognized for the hard work they're putting in, right? And so that's why I was super excited to get you on and have this conversation. It's a little dry because it is insurance, but it's super exciting because of the possibilities. And no doubt if somebody's listened to this point, they have heard of, know somebody that's in a captive and they're interested, right? And so, that's what we want to do. We've been asked, we've delivered, it's here. So.
There we go. And I appreciate any listeners that are still on right now, so making their way through the 50-minute mark of talking about insurance. If we maybe we'll get find a trucker out there and they join the captive, and next time we'll do this and interview them too. We'll bring them on and ask some questions on how
we'll do an on-site, or we'll travel to them, or we'll do a little bit of a business meeting, a little bit of golf, a little bit of podcast, a little bit of whatever we need to do, man. Or we can go safety. We'll do a safety meeting.
There we go.
I don't really care. I mean, I think it'll be good. So cool, man. Well, Ian,
I like it.
Yeah. What up, Brian?
I just said a safety meeting can still include golf.
That's right. Yelling for and avoiding getting hit by a golf ball.
There we go.
Would be good. So, Ian, we appreciate your time, man. Thank you so much. We'll share kind of the resources and the notes. And obviously, if anyone's interested in learning a little bit more about captives, go to our website, reach out to Ryan and myself. And all we need is a DOT number. We can do some preliminaries on that. We'll figure out, is it, we'll shut it down or move you on based on that. And then if you're not ready, now we have actually some talking points to go over in coaching and a little bit of a roadmap that can help us get you there. So, I mean, that would kind of be my preach or pitch to that. So, Ian, thank you so much. I look forward to hanging with you here in a few short weeks. Ryan, thank you for joining. Appreciate it, man. Bye.
Thanks, everybody.
Thank you, guys.